And what we're going to do now is start the basics class. Okay, so let's get started on 10-minute basics. And today's topic is going to be the theta of a vertical spread. We discussed this in a podcast 1 or 2 weeks ago, where people were a little bit confused about whether a vertical spread has positive time decay or negative time decay relative to where it is around the stock price. Is the in the money, at the money, or the out of the money vertical spread that you're long benefiting from time decay? And I went through it very quickly in the class, and we're going to go through it right here in a little bit more detail because now we have slides prepared, which I didn't have at the time. Now, what I did yesterday in anticipation of the class being done was pull up an SPX chain with 1 day until expiration, 5 days until expiration, and 14 days until expiration. And the closing price was 48.68.55 in the SPX. This is the SPX chain. And what you'll see here, all of these are calls. I didn't focus on the puts because the puts will be a mirror image of the calls. So we'll have, with the strikes starting at 47.95 going up to 49.40 on these chains, we'll be able to pick up call spreads that are deep in the money, call spreads that are at the money, and call spreads that are out of the money. The only downside to this exercise is I took prices after the market closed, because doing it during the market hours, even taking a snapshot of the 5 day, 1 day, and then the 14 day, seconds apart, can have the minis off by $2, $3, $4, and not give an apple to apple comparison with the cash at the same price. The negative of doing this after hours is, for whatever reason, the exchanges never are able to settle the option prices at the actual correct theoretical value, despite all the computers helping. And you're going to see some whacked out prices in terms of the option chains. Okay, I mean, I can eyeball the option chain and just look and see that some of these options are out of price or mispriced. Now, what I did is I took that existing option chain and put it into a spreadsheet so that the math would be cleaner. Well, on this, it's a little bit difficult to read, but we can come back to it later, and you're going to get a copy of the slides. But it's a little bit difficult to read because the numbers are so small, so I blew up just a portion of it here to get bigger numbers. And again, you see that the SPX closed at 48.68.55. And so when I go and start this chain, 48.65 and higher, and all these are calls, which would make sense by looking at the price of the call spreads. The 65.70 call spread is going to be trading for 320, because here's the price of the option at the 65 strike. Here's the price of the 70 call. The difference between the two is 320. So if I wanted to look at, say, the 48.95, 4900 call spread, it's right there. And this spread column right here, here, and here makes looking at the price of the vertical spread a lot easier. What you're also going to notice is something kind of weird. This $5 spread closed at $13.10. Kind of weird, right? Well, they mispriced some of these options. that is the negative of taking an option chain after the market closes. Some of the options just don't get updated, but it doesn't matter for the purposes of what we're trying to do here. I'm trying to illustrate, and I'm going to do it two different ways. So if this way frustrates you, I have a different way. What you're going to see is that the at-the-money options, the at-the-money spreads with 1 day, 5 day, and 14-day really don't change much. In other words, if I bought the 14-day 2-week out 65.70 call spread for 330 and held it for 2 weeks and the market didn't move at all, the spread I bought for 330 is now trading 320. I haven't really lost anything. When I go further out of the money, though, we can go and look at, say, the furthest out of the money, 49.20.25 call spread. With 1 day to go until expiration, it's trading for 20 cents. 5 days, 90 cents. And 14 days, $1.80. So if I went and bought an out-of-the-money call spread, hoping that the market jumped up, but we just sat for 2 weeks, the spread I bought for 180 is going to start sinking. 9 days later, I lose about half my value. And then 4 days later, it's down to 20 cents. The market hasn't moved. Volatility obviously hasn't moved because these are taken on the same day. The only thing that's changed between the 1 day, 5 day, and 14-day vertical spreads is the days until expiration. And the phenomena that is killing these option spreads is theta. For you guys who like times or the normal distribution curve, basically this is the 14-day chain. And when we're looking at something like the 20-25 call spread, there's a decent chance we can get there. But we know that this distribution curve shrinks as time goes closer and closer to expiration because there's less time for the market to move big. And so the new normal distribution is going to look like this. And the 20-25 call spread pretty much has almost no chance of getting that far unless something extraordinary happens, and that's why it's trading for 20 cents. Now, a different way of looking at this, and we'll shut it down here, is this. Here's the 1 day until expiration spread at the 80-85 strike. This is slightly out of the money when the market's at 48.68.55. And you see that the spread at the asks in the red box is $9.20 minus $7.20 or $2 on that vertical spread. If you go and look at the theta, what do you notice? This option is going to lose $8.80 in time decay over 1 day if the market doesn't move. And the other option is going to lose $6.80 in time decay, or how much? $2. So the theta on the spread is $2, which is coincidentally what the price of the spread is, which makes sense with 1 day until expiration because the spread is going to expire worthless if we close at 80 or higher. Or excuse me, 80 or lower, and if the market is closed at unchanged at 48.68.55, this 80-85 call spread is going out worthless. You expect to lose the full $2, which is the $2 of theta. Now remember, theta is a negative. So when I buy this option for 880, it's a negative 880 because I'm buying this option. Then I'm selling the 85 strike, which is a negative 680. So a negative times a negative is a positive 680. That's offsetting my theta by 680. And now I'm down to $2, a minus $2, which is the cost of the spread. Another example. Here's the 5 days until expiration, not 1 day. When 1 day goes to expiration and the market doesn't move, you expect an out of the money call spread to go out worthless. Here, we have 5 days to expiration. At the end of the day, there will be 4 days remaining. We still expect the spread to have some value left, yet we also expect it to lose some value. How much will it lose? Well, here you see this trade is going for what? With 5 days until expiration, it's going for how much? $2.40. If I bought this spread, it'd be a $2.40 debit. How much will it lose? All variables remaining constant by the end of the day, if the market stays at 48, 68, 55. So we don't bring deltas or anything else into the equation. Volatility hasn't changed, nothing. Here, see the difference between the two thetas is 10 cents. So this spread will go from 240 to 230 if the market doesn't move. So here's the takeaways from theta. An in the money vertical spread has positive theta. Remember, the at the money option is going to have the most theta, the most vega, etc. So if we're buying this option and we're selling this option that's in the money, we're actually collecting a positive theta instead of on this side where we buy and out of the money, we're spending this much on theta and we're only receiving this much on theta. We're paying theta out. And in the money option has positive theta, meaning long spreads are going to make money as time till expiration approaches. At the money vertical spreads are pretty much neutral theta because you buy that option, you sell this option, the thetas cancel out. And out of the money options, or vertical spreads, I should say, for clarity, have a negative theta, meaning money is lost due to time decay, and we saw that in the example. Now, I don't know if this helps anybody here, but every single class, unless we're really focusing on something complicated that's going to take up a lot of time, is going to have a quick 5-10 minute review on some form of basics. If you miss it, it's not a big deal. It'll eventually be up on YouTube.